Hello dear students, myself CMA Padmaja Buzruk. I will discuss accounts of joint stock companies. Please go to study note number 1, accounting of shares and debentures. I will explain few illustrations. Go to illustration number 4. A limited company was registered with a capital of rupees 5 lakhs in shares of 100 each. Rupees 5 lakhs and face value of each share is 100. So number of shares are 5,000. 5,000 into 100 makes 5 lakhs. 5 lakhs is registered capital, which is also known as authorized and nominal capital, and issued 2,000 such shares at a premium of 20 per share. So company has issued 2,000 shares out of 5,000 shares, and these shares are issued at a premium. So while passing journal entries, you have to take into consideration 2,000 number of shares, which is issued capital. Shares are issued at 20 rupees premium. Payable as 20 per share on application, 50 per share on allotment including premium. 50 includes 20 rupees premium, so breakup is 30 plus 20. 20 per share on first call made 3 months later. All money payable on application and allotment were duly received, but when first call was made, one shareholder paid the entire balance on his holding of 30 shares, and another shareholder holding 100 shares failed to pay first call money. So in short, what is given here is when first call was made, one shareholder who was having 30 shares paid the entire balance on his holding of 30 shares. That means he has paid final call money along with first call. So on 30 shares at the time of first call, there is calls in advance on 30 shares. Whereas one shareholder who was having 100 shares failed to pay first call money. So on 100 shares there is calls in arrears, and on 30 shares there is calls in advance. You are required to give journal entries to record the above transactions. Now see how it is given. Illustration 4. Company was registered with capital which is 5 lakhs rupees in shares of 100. So that means registered capital is 5,000 shares of 100. Issued capital 2,000 shares at a premium of 20. So issue price is 100 plus 20, 120. Payable 20 on application, 50 on allotment including premium. So breakup is 30 plus 20. 30 will go to share capital, 20 will go to securities premium. All money payable on application and allotment were duly received. So there is no default as regards allotment. 20 per share on first call, which is made 3 months later. So 20 rupees on first call. On 100 shares, first call was not received. So there is default on 100 share. One shareholder holding 100 shares did not pay first call money. So that means first call money they have received on 1900 shares only. Final call was received on 30 shares. That means one shareholder who was having 30 shares, he has paid entire amount along with first call. So he has paid final call with first call. So on 30 shares there is calls in advance. So you need to find out what is final call money. 120 is issue price, 100 face value plus 20 premium, minus 20, this is application money, minus 50, this is allotment money, minus 20, this is first call money. So remaining balancing figure is 30, which is due on final call, balancing figure. So we'll see how journal entries are to be passed. 2,000 shares. First you have to show application money received on 2,000 shares at rupees 20 per share. Bank account debit to share application and share application to share capital 40,000, 2,000 multiplied by 20. Next entry is you are supposed to show allotment money due and allotment money received. 2,000 into 50 is due. Out of that, 30 should go to capital and 20 should go to securities premium. Share allotment account debit 2,000 into 50 to equity share capital 2,000 into 30 to securities premium account 2,000 into 20. Figures are jumbled up. 2,000 into 50 is 1 lakh, 2,000 into 30 is 60,000 will go to share capital and securities premium amount is 40,000, 2,000 into 40. Whatever was due has been received. 1 lakh was due, they have received 1 lakh. Bank to allotment 1 lakh. Now next is call money. Call money is 20 per share, but they have not received on 100 shares, they have received only on 1,900 shares. Whereas final call money on 30 shares they have received with first call. So you have to be very careful while passing these journal entries. Share first call account debit to share capital. This entry is to show call money due on 2,000 shares at 20 per share. 2,000 into 20, 40,000. Bank account debit 38,900 to share first call. They have received on 1,900 shares. 1,900 into 20, 38,000. To calls in advance on 30 shares. On 30 shares they have received final call money which is 30. 30 into 30. So total is 38,900. They have received at the time of first call 38,000 on account of first call money and 900 on account of final call money which gets transferred to calls in advance account. So first call due was 48,000 but they have received 38,000. 2,000 will get transferred to calls in arrears. Calls in arrears to share first call. Now these three set of entries you can pass in different manner also, like share first call to share capital 40,000. Then first clear this share first call 40,000 by passing entry. Bank account debit 38,000, calls in arrears debit 2,000 to share first call 40,000. On 100 shares they have not received first call money. So share first call 40,000 debit, 40,000 credit, and then bank account debit to calls in advance. Received final call money on 30 shares. So this way also you can pass journal entry. So it will be easy for you to understand. Now we'll go to illustration 5. B Limited purchased the assets of 10,80,000 from C Limited. Consideration was payable in fully paid equity shares of 100 each. So B Limited has purchased assets. Value of asset is 10,80,000. But they have not paid cash. They have not transferred money. Consideration was fully paid equity shares of the face value 100. We are required to show journal entries in the books of B Limited assuming that such shares are issued at par, that means at 100, and such shares are issued at premium of 20%. Shares are issued at 20% premium, so issue price will be 100 plus 20. 20% of 100 is 20. So issue price is 100 face value plus 20 securities premium 120. While passing journal entries, you have to be very careful. First, you need to calculate number of shares in both the cases A and B. Calculation of number of shares when shares are issued at par. 10,80,000 worth assets they have purchased, and if shares are issued at par, that is 100, The number of shares are 10,80,000 divided by 100, 10,800. Now, in this case, your journal entry would be sundry assets to C Limited, 10,80,000 assets purchased from C Limited, and C Limited to equity share capital 10,80,000, 10,800 shares into 100. So, in the situation A, these two entries are to be passed. In situation B, that is when such shares are issued at premium, number of shares would be 9,000 because issue price is 120. 10,80,000 worth assets they have purchased divided by 120. Issue price of each share is 100 plus 20, 120. Number of shares are 9,000. Now in this case, your journal entries would be sundry assets to C Limited. This entry would be same, but C Limited account debit to equity share capital to securities premium. Which amount gets transferred to equity share capital? 9,000 into 100, and to securities premium 9,000 into 20. Why 9,000? Because number of shares are 9,000. 9,000 into 100 would go to share capital account, and 9,000 into 20 would go to securities premium account. Now we'll go to illustration 7. On 1st May 14, Superman Limited issued 5,000 equity shares of 100 each payable as follows. On application rupees 20, on allotment rupees 30, on first call rupees 20, and on final call rupees 30. Last date fixed for payment of first call and final call is given, which is 31st July and 30th August respectively. Applications were received on 15th May 14 for 6,000 shares, and allotment was made on 1st June 14. Issued capital is 5,000 shares, but number of applications received are 6,000. More applications are received. This is the case of oversubscription of shares. Applicants for 2,500 shares were allotted in full. Those for 3,000 shares were allotted 2,500 shares, and applications for 500 shares were rejected. So, 2,500 applicants, they have allotted 2,500 shares. Then next lot of 3,000 applicants, they have allotted 2,500 shares, and next lot of 500 shares they have rejected. Balance of amount due on allotment was received on 15th June. So some adjustment is made. They have received more number of shares than issued capital. Some adjustment is made pro rata allotment. So balance money due on allotment they have received. There is no default in allotment. The calls were duly made on 1st July and 1st August respectively. First call on 1st July and final call on 1st August. One shareholder did not pay first call money on 150 shares, which he paid with final call together with interest 5% per annum. So there is default as regards first call money. On 150 shares, first call was not received, but he made payment of first call with final call at 5% rate of interest. Last date of first call was 31st July, whereas last date of final call was end of August. So there is only 1 month delay. So you have to calculate interest at 5% for 1 month because he has paid with final call. Another shareholder holding 100 shares did not pay final call money till the end of accounting year, which ends on 31st October. Final call was due on 30 August. One shareholder who was having 100 shares He has defaulted in making final call money. He has not paid final call on 100 shares, and this default continued till the year end, which is on 31st October. Till 31st October, he has not paid final call money. So you need to calculate interest on this also from August end to October end. September and October, 2 months interest on final call and only 1 month interest on first call. Now I will show you calculation. Applications received are 6,000 whereas issued capital is 5,000. First 2,500 applicants, they have allotted 2,500 shares. Next lot of 3,000 applications, they have allotted 2,500 shares. So this is the case of pro rata allotment. They have received 3,000 applications but they have allotted only 2,500 shares. Pro rata allotment on 500 shares. Third lot, they have received 500 applications. No shares are allotted. All applications are rejected. So total number of applications received are 2,500 plus 3,000 plus 500 is 6,000. Shares allotted are 2,500 plus 2,500 plus 0, 5,000. So number of applications rejected are 500. Pro rata allotment applications are 500. See, applications received 6,000, shares allotted 5,000, excess applications received 1,000 applications they have received extra. Out of that 500 applications are rejected, and whatever application money received on the remaining 500 applications, it got adjusted against allotment. So it is pro rata allotment. Issued capital 5,000 shares. You have to consider 5,000 while passing journal entries. Amount payable on application 20, allotment 30, first call 20 and final call 30. Application money received on 6,000 applications. So how much they have received? 1,20,000. But which amount should go to capital? Only 5,000 into 20. 1 lakh should get transferred to share capital account because issued capital is 5,000. So the difference in this 1,20,000 they have received, but 1 lakh will go to share capital. Difference 1,20,000, 1,20,000 minus 1 lakh is 20,000. Excess received with application. How it is to be adjusted? Just now we have seen this. Applications rejected 500, pro rata allotment 500. So 500 into 20, 10,000 out of this 20,000 excess, 10,000 will be refunded back. And 5,000 into 20, 10,000 will get adjusted towards allotment. This we have seen. 2,500 applications received, 2,000 shares are allotted. In the second lot, 3,000 applications are received, 2,500 shares are allotted. Ratio is 6:5. That means if a person has applied for 6 shares, he will get 5 shares. So number of excess applications received here are 500. 500 into 20, 10,000. They won't refund it back, but it gets adjusted towards allotment. In the third lot, 500 applications are received and all applications are rejected. So whatever money they have received, 500 into 20, 10,000 is refunded back. Now we'll see default. In case of first call, there is default on 150 shares. So that means they have received money on 4,850 shares. 5,000 minus 150, 4,850 on these shares first call is received. But this due amount was paid with final call at interest 5% per annum. And there is default on final call also on 100 shares. So that means final call money is received on 4,900 shares. 5,000 minus 100 is 4,900. First, application money received. Bank account debit to share application 1,20,000. On 6,000 applications, they have received rupees 20 per application. Out of 1,20,000, 1 lakh gets transferred to share capital because issued capital is 5,000. So next entry, share application account debit 1,20,000 to share capital 1 lakh 5,000 into 20. To share allotment 10,000 to bank 10,000. 10,000 will get adjusted towards allotment, 10,000 will be refunded back. I have shown you these calculations. Next is allotment due. Share allotment to share capital 5,000 into 30. Whatever was due has been received. There is no default in allotment. So bank account debit to share allotment 1,40,000. Out of 1,50,000, 10,000 is already received with application. In the second lot, they have received 3,000 applications, but shares allotted are 2,500. So on 500 applications at 20, they have received with application. So this 10,000 they have already received with application. So this is 1,40,000. So share allotment debit 1,50,000 and credit 1,40,000 and 10,000. So debit and credit matches. Next entry is first call money due. Share first call to share capital 5,000 into 20, 1 lakh. But there is default on 150 shares. They have received on 4850 shares. So bank account debit 97,000. Calls in arrears account debit 3,000 to share first call 1 lakh. 4850 into 20 they have received, 150 into 20 they have not received, which gets transferred to calls in arrears account. Next entry is for final call. Final call due entry is share final call to share capital 5,000 into 30 is due. Have they received whatever was due? No, there is default on 100 shares. So they have received only on 4,900 shares. Bank account debit 1,47,000. Calls in arrears account debit 3,000 to share final call 1,50,000. On 100 shares, they have not received final call at 30 per share. That means 5,000 minus 100, they have received only on 4,900 shares. Now you have to calculate interest on calls in arrears, that is first call. First call last date which was fixed for first call was 31st July. But on 150 shares, first call was due. The shareholder has cleared it with final call. So interest is to be calculated only for 1 month. That is from 31st July to 30th of August. But in the book they have calculated for 2 months. They have calculated 25 rupees, which is not correct. It is only for 1 month. First call last date was 31st July. Final call last date was 30 August. So first call he has paid with final call. So there is only 1 month delay. Shareholder account debit to interest on calls in arrears and bank account debit to shareholder. If you see here, shareholder 1 debit, 1 credit, it cancels off. So net effect is bank account debit to interest on calls in arrears. Now how this interest is to be calculated? It is given in the question. That is, what is the rate of interest? See here, 5% per annum. And what is calls in arrears amount? That also we have seen. First call in arrears 3,000. So on 3,000 at 5% for 1 month. On 3,000 at 5% for 1 month. 3,000 into 5%. divided by 12. That is how you should get this interest, and entry is shareholder to interest on calls in arrears and bank to shareholder. Whatever was interest due, they have received. Now, this first call money they received with final call, and that amount was 3,000. Bank account debit to calls in arrears. So at the time of first call, see here, you have transferred 3,000 to calls in arrears to first call. This calls in arrears was received, so bank to calls in arrears. So calls in arrears account will get closed. Then you have to pass entry showing interest due on final call. Final call was due on end of August, and till accounting year end they have not received final call. So September and October 2 months interest you have to calculate. Now again, final call in arrears amount is 3,000 on 3,000 at 5% for 2 months. 3,000 into 5% divided by 12 multiplied by 2 will be 25. So till the year end they have not received this 25 rupees. That is how entries are to be passed. Now cash book will see. Equity share application they have received 1,20,000, out of that 10,000 is refunded back. So to equity share application, by equity share application, refund. Equity share allotment they have received 1,40,000 because 10,000 they have received with application. First call money they have received 97,000. Final call money they have received 1,47,000. First calls in arrears they have received 3,000. But interest on calls in arrears, that is on first call, is not 25 rupees but it is 12 rupees 50 paisa. So change this to 12 rupees 50 paisa. It is not for 2 months which is shown in the books, it is for 1 month. So this total will change and your balance carried down will also change. So make these necessary changes in the cash book. So in this particular video, I have explained you various illustrations. Thank you.